Man, I thought I was going to have a weekend off. Just kidding. Thanks, Mr. O, for bringing this up. I shortened your name to protect your identity. I did expect some Title 12 changes, but not to this extent. What we're looking at here is the CFR rules, and specifically Title 12, which is for banks and banking. And we have changes, a lot of changes to Part 50, Liquidity Risk Measurement Standards, Part 249, Liquidity Risk Measurement Standards and Monitoring, or Regulation WW. And then we also have Part 329, Liquidity Risk Measurement Standards. So, as you can see, it's all related to liquidity. And I'm going to go over a lot of the relevant ones and see, the changes. But to give you an example of what it's going to look like when you go to one of these, all of the changes are going to be red for anything taken out, green for anything added in. So there could potentially be some very, very relevant changes occurring at a very particular time. So yeah, can't wait to dive into all this. Just wanted to bring this to your attention that there has been a plethora of changes to Title 12 banks and banking. I mean, look at that. That is insane. So we'll see what's inside. Okay, so I'm going to make this as simple and as clear as possible. While this is a very complicated topic, we do have a plethora of new rules that have literally just been established for CFR, which is the Code of Federal Regulations. And guess what? Most of them, the vast majority, there's like 55 or so rule changes. They all have to do with the banking sector, and specifically liquidity risk measurement standards, and in this particular case, they've even added the word monitoring. So we're going to be looking at Title 12, Part 249 in this video. We're going to go over the general title change and a few definitional changes, and let's get this thing started. So this is a brief view of just 2 out of 3 parts that were changed. There's another section with just this much amount of rules on it that have been changed as well. We're going to be looking at liquidity risk measurement standards and monitoring, and some of the definitions that have been changed along with it. And this is big changes to the banking sector. So the changes, well, the title, they literally added a comma and the word "and monitoring." So I guess they're actually going to start monitoring the liquidity risk. About time. Now if you look at this, they added this entire paragraph. Anything in red with a strike through it is removed language. Anything with green in it is added language. The board may require a board-regulated institution to maintain an amount of available stable funding greater than otherwise required under this part, or to take any other measure to improve the board-regulated institution's stable funding, if the board determines that the board-regulated institution's stable funding requirements as calculated under this part are not commensurate with the board-regulated institution's funding risks. In making determinations under this section, the board will apply notice and response procedures as set forth in 12 CFR 263.202. Now, they just moved paragraph C and renamed paragraph B originally is now renamed to paragraph C, and then they added in deficient stable funding levels. The paragraph reads, "Nothing in this part limits the authority of the board under any other provision of law or regulation to take supervisory or enforcement action, including action to address unsafe or unsound practices or conditions, deficient liquidity levels, deficient stable funding levels," which is this new terminology that they've added, "or violations of law." So it sounds to me like this is a new term they've created to hold some people accountable. Now, changes to the definitions continued. Collateralized deposit. In paragraph 1, the only added language we see is required to be. Before, it was just a deposit of a public sector entity held at the board-regulated institution that is secured under applicable law, and now it is required to be secured, so that's good. Paragraph 2 is interesting because a deposit of a fiduciary account awaiting investment or distribution held at the institution for which the institution is a fiduciary and is required under the National Banks Law through the Federal Savings Associations and applicable state laws to set aside assets owned by the board institution as security, which gives the depositor priority over the assets in the event and this is the cool part, the institution enters into receivership, bankruptcy, insolvency, liquidation, resolution, or similar proceeding. So yeah, it's starting to get a little jacked here. Now, they also added a new term. I'm sorry if you can't see it. It may cut it off. I'm going to leave a copy of this PowerPoint in the description so you can see. But this reminds me a little bit of Skyrim. They have added the term encumbered. Now it says encumbered means with respect to an asset that the asset is subject to legal, regulatory, contractual, or other restriction on the ability of the board institution to monetize the asset, such as GameStop or AMC, is pledged explicitly or implicitly to secure or provide credit enhancement to any transaction, not including when the asset is pledged to a central bank or a U.S. government-sponsored enterprise, where potential credit secured by the asset is not currently extended to the board institution or its consolidated subsidiaries, and the pledged asset is not required to support access to the payment services of a central bank. In other terms, you can't have already used it. It has to be good. Now, check this out. Unconditionally cancelable means with respect to a credit or liquidity facility that an institution may at any time, with or without cause, refuse to extend credit under the facility to the extent permitted under the applicable law. Now, holy cow, that's some real change. That's like the heart of the rule book. So it's funny that, I don't know. It's just, we're going to look into all these. It's going to take some time, but wow, looking at the very first one, the fact that they've added some of the stuff they just added that we just saw, very, very, very positive. So let's go. What's going on, everyone? I hope you're all having a great 4th of July weekend, and happy 4th to all of you. We're living in unprecedented times, and I'm going to go over the Title 12 banking changes that we saw happen yesterday in a little bit more detail, and hopefully give a better understanding to most of you all out there who are still struggling to comprehend what I'm talking about. So let's go ahead and break this down. Now, before you get confused by the amount of crap on the screen, let me break it all down for you. We're going to start from the top. 12 U.S. Code, Title 12, Banks and Banking. So all Title 12 is, it's the section of the U.S. Code that is specifically regarding banks and banking. Now, I woke up yesterday on July 3rd, 2021 to 130 changes. 130 changes. The crazy part, the changes only affected 4 components of this act. Now, the components I'm speaking of are the parts. So essentially, whenever you hear this subject brought up, we're only talking about 4 components of the act, which are called parts. Now, out of these 4 parts, I'm only going to be focusing on Part 249, because this is the one that is the most relevant to stocks and bonds. I'm going to go over all of that in a second, but I just wanted to explain that before you think this is going to be all confusing, I'm going to briefly explain these 3 parts, and then I'm going to focus primarily on 249 to start. So we have Part 50, which is Liquidity Risk Measurement Standards. We have Part 702, which is Capital Adequacy. And we have Part 249, Liquidity Risk Measurement Standards and Monitoring. And we also have Part 329, which has the same title as Part 50. Now, how can they have the same title? Well, if you look at the authority, they have a different subset of governing rules. That is the difference. And they also affect different financial institutions. So now that we see the 4 parts affected, Parts 50, 702, 249, and 329, let's go ahead and take a look at some of the parts individually and what they affect and if they're relevant. So, Part 50, Liquidity Risk Measurement Standards. You can, if you want, these arrows are cross-referencing arrows. So if you want to look at when this first came about, you can click on the source link. It'll bring up an enhanced content cross-reference page here. And then if it says effective date not available, you will have to dig into the filing to find it. So I found this was first implemented on January 1st, 2015. So changes have not been made since then. Now, for the second source, 61538, which the numbers here, all they're doing is they're referencing a federal release number, which you can see matches right here. So for Part 50, the sources for Part 50 is 79FR61523, implemented on January 1st, 2015, and we also have 61538. Now this one's interesting because the Fed Register could not retrieve the citation data, and I searched the Fed Register for it and still could not find it. Anyways, Part 50, what is it? Well, the purpose of Part 50 is to establish a minimum liquidity standard and a minimum stable funding standard for certain national banks and federal savings associations on a consolidated basis as set forth herein. Now, anything in green that's highlighted is added language, meaning it was not previously here before. Anything red with strike through has been removed. So this would have previously read, this part establishes a minimum liquidity standard for certain national banks and federal savings associations on a consolidated basis as set forth in this part. So they changed it up a little bit. Now, what does Part 50 affect? National banks and federal savings associations. Well, what's a federal savings association? Well, a savings association, which is defined from this same rulebook, includes any savings association or former savings association that retains deposits insured by the corporation, notwithstanding termination of its status as an institution insured by the corporation. That's basically it for Part 50. Now, Part 329. To cross-reference, we go look at 61523. Same thing, January 1st, 2015. And this is probably the least of my priority when it comes to the parts I'm going to look at, because it only affects FDIC supervised institutions on a consolidated basis as set forth herein. Now, example of FDIC insured banks, basically everyone. There's 5,000 banks directly supervised by them. So just keep that in mind. This is probably the one I'll look at last. But yeah, I mean, just check out these dates. JP Morgan, Bank of America, Wells Fargo, Citibank, all established basically in the 1800s. That's insanity. And then there's some more examples down here of FDIC insured. So, Part 702, capital adequacy. Cross-reference source would be 8584, which we can see was published on February 18th, 2000. So, long time since this one. The purpose of capital adequacy, it says right here, the express purpose of prompt corrective action under Section 1790D is to resolve the problems of federally insured credit unions at the least possible long-term loss to the National Credit Union Share Insurance Fund. This part carries out the purpose of prompt corrective action by establishing a framework of mandatory and discretionary supervisory actions, applicable according to a credit union's net worth ratio, designed primarily to restore and improve the net worth of federally insured credit unions. Again, this one is least of my concerns right now. The one I'm going to dig into, the part that I will look into the most, is this one. Part 249, Liquidity Risk Measurement Standards and Monitoring. Now, we know that because of the green language, the comma and the words and monitoring were literally just added, meaning they were not there before, meaning disclosure is now a first-time thing when it comes to this. So if we use the source reference, boom, jackpot, effective date July 1st, 2021. And the 65139, I believe, I'll need to look that one up and cross-reference that as well. Oh, that was October 10th, 2014. Okay, perfect. So we have this one effective July 1st, 2021, and let's see what the purpose of this part is. Well, this part establishes a minimum liquidity standard and a minimum stable funding standard. This was just added for certain board-regulated institutions on a consolidated basis as set forth herein. Now, what's a board-regulated institution? Well, A board-regulated institution means a state member bank, bank holding company, or savings and loan holding company. What's a state member bank? Well, a state member bank means a bank that is chartered by a state and is a member of the Federal Reserve System. What's a bank holding company? A bank holding company is a corporation that owns a controlling interest in one or more banks, but does not itself offer banking services such as Berkshire Hathaway. What is a loan holding company? A loan holding company assets may include limited liability companies or partnerships, real estate, patent trademarks, stocks, bonds, and more. There we go, stocks. A savings and loan holding company is a company that owns or controls one or more savings association subsidiaries. The Board of Governors is responsible for regulating and supervising SLHCs. Below is a list of SLHCs headquartered in the 5th District and supervised by the Federal Reserve Bank in Richmond. So, this is the governing authority map of Part 249. So, we have the authority here. Now, if you go and you cross-reference all of these rules, you can find out a lot more about what this all means. So, I'm just going to go through this briefly. So, 12 USC 248, paragraph A, the title is Enumerated Powers. A says examination of accounts and affairs of banks, publication of weekly statements, reports of liabilities and assets of depository institutions and covered institutions. 321 through 338A, application for membership. Basically all it talks about. Looks like I forgot 481, 486. I'll get back to that one. 1467 AG1. 1467A is regulation of holding companies. G, administration and enforcement. And then paragraph 1, we see in general, the board is authorized to issue such regulations and orders, including regulations and orders relating to capital requirements for savings and loan holding companies as the board deems necessary or appropriate to enable the board to administer and carry out the purpose of this section, and to require compliance therewith and prevent evasions thereof. So you're getting these authoritative rules telling you why they're allowed and how they're allowed to make these changes, such as establishing a monitoring system, redefining terms, reinterpreting language. Basically gives you justification and legality behind what they're doing. Now, hopefully that cleared up the parts in all this. Again, just to reiterate, there's 4 parts in the U.S. Title Code, Title 12, that were affected yesterday, combining for 130 changes. Part 50, Part 702, Part 249, and Part 329. Between these 4 parts, Part 249 is the one I'm going to be looking into primarily because it deals with stocks and bonds. Next, I'm going to break down all of the new definitions found in this part, what they mean, and how they affect the balance sheets of the banks when they must inevitably report. Hopefully this cleared things up. This is crazy stuff. If anyone tells you otherwise, they do not know what they're talking about, because again, we have added language and we have a new calculation for banks to calculate their liabilities and assets. So this is getting heated up. Happy 4th, everyone. Part of the reason why I love doing this right now is because it's taking things that were once completely irrelevant and it's bringing them to the surface, making them relevant. And this stuff is cool in my opinion. So hey, we're going to talk about ASF factors, another huge change to the Title 12 rulebook, which by the way, Title 12 is the banking sector. Very, very relevant to the situation. And the part or the section of this rulebook is entitled Liquidity Risk Measurement Standards and Monitoring, which last time we discovered that the monitoring part, they literally just added in. So let's go ahead and take a look at an ASF factor and what that is. So last time, of course, we looked at the general rule and the title. We saw there was a change in the title itself, added the word "and monitoring." Then we looked at some new definitions and some old definitions as well. So now let's get into ASF factor, right? So what is it? I'm going to read you the definition and then tell you what to think or how to think of it in simple terms. So an ASF factor is assigned to the carrying value of each element of funding And ASF factors range from 100%, meaning that the funding is expected to still fully be available in more than a year, to 0%, reflecting that funding from this source is unreliable. So in simple terms, think of this as a reliability scale for elements of funding, different elements of funding. And this is talking about the broad banking sector when I use the word funding. So variety of different meanings for that word. However, this category of this rule is breaking down the different thresholds, being 100% versus 50%, and telling you what makes certain funding fit into each threshold. So another term you're going to hear is NSFR, regulatory capital element, and NSFR liabilities. Now all that is the NSFR is a bank requirement to maintain stable funding profile in relation to the composition of their assets and off-balance sheet activities. So in order for a ASF factor, or in order for funding to still have a 100% chance of being available in a year, you're going to have a stable funding profile based on sentence 1, or you can also have a liability, but it has to have a maturity of 1 year or more from the calculation date. It cannot be described in paragraph D9 and is not a retail deposit or broker deposit provided by a retail customer or counterparty. That is the only thing that can be considered 100%. Now, what is paragraph D9? This actually falls under the 50% ASF factor. So an NSFR liability owed to a retail customer or counterparty that is not a deposit and is not a security issued by the board is a 50%, or there's only a 50% chance it would still be available in a year. So it's crazy to see them making these adjustments as we're living through all this, because this is FTD related. That's what they're relating to. Or in other words, things they don't own, like short positions. Now, NSFR liabilities assigned a 0% ASF factor, meaning there is a 0% chance funding will be available, is assigned by one of the following qualities. A trade date payable that results from a purchase by the board institution of financial instrument, foreign currency, or commodity that is contractually required to settle within the lesser of the market, lesser of the market being the stock market, standard settlement period for the particular transaction, and 5 business days from the date of sale. Sounds like another fail reference. Can't be a broker deposit provided by a retail customer or counterparty. That is not a broker reciprocal deposit or sweep deposit. Is not held in a transactional account and matures less than 6 months from the calculation date. So there's no chance that they can use our money to fund whatever the hell they want, because they can't use a retail customer account, which is scary that they were allowed to do this before. It can't be a security issued by the institution that matures less than 6 months from the date. And an NSFR liability with the following characteristics are also assigned as 0%. The counterparty is a financial sector entity, a consolidated subsidiary of a financial sector or a central bank. The NSFR liability matures less than 6 months from the date or has an open maturity. And the liability is not a security issued by the institution or an operational deposit placed at the board regulated institution. And lastly, or any other NSFR liability that matures less than 6 months from the calculation date and is not described in paragraphs A through D or E1 through 4. So there you have it. Those are a lot of changes to the banking sector. And again, look at all this. So there's a lot to break down here, but I'm loving what I'm seeing so far. A lot of accountability starting to happen. So we'll see. Hopefully it's not a backdoor. You never know with these people. I'll keep explaining as I go through them. Okay, so we've broken down the 4 parts affected, determined that part 329 was the most relevant, and then we went over the different institutions and how they were affected by this. And now we're going to look into definitions and the NSFR standard that all of these banks must now meet the threshold for. So now that we know parts 50 to 49, which is the one we're discussing in this video, 329 and 702 are the parts or components that saw changes in the Title 12 sector. And we also know which institutions are affected and classifications of each institution. And we also know that in the event that they do not meet this new NSFR threshold that we're about to discuss, the board has the authority to take prompt corrective action, including requiring the institution that is not in compliance to sell assets to meet the new threshold. So what's the new threshold? Well, it's called the NSFR. And the NSFR is defined as the ratio between the amount of stable funding available and the amount of stable funding required. Must be a 1.0 or higher. It's a long-term resiliency measurement. Anything less than a 1.0 will be considered an NSFR liability. So before we can look at the NSFR itself, we need to look at some new definitions that are going to be within the NSFR definition that will help clear it up. So new definitions, and by the way, this is effective July 1st. New definitions, the proposed rule would have added several new definitions, being carrying value, which means with respect to an asset, the NSFR regulatory capital element, or NSFR liability, the value on the balance sheet of the board institution, each as determined in accordance with GAAP. We have encumbered, another new definition. Encumbered means with respect to an asset that the asset is subject to legal, regulatory, contractual, or other restriction on the ability of the board-regulated institution to monetize the asset, or it is pledged, explicitly or implicitly, to secure or to provide credit enhancement to any transaction, not including when the asset is pledged to a central bank or a U.S. government-sponsored enterprise, where potential credit secured by the asset is not currently extended to the board-regulated institution or its consolidated subsidiaries, and the pledged asset is not required to support access to the payment services of a central bank. We also have the NSFR regulatory capital element, which is literally just including equity and liabilities under GAAP that meet the requirements of the definition that we're about to see. NSFR liability, anything that does not meet that 1.0 or higher threshold will be considered an NSFR liability. QMNA netting set means a group of derivative transactions with a single counterparty that is subject to a qualifying master netting agreement and is netted under the qualifying master netting agreement. And lastly, a unsecured wholesale lending, we will see on the next page, means a liability or general obligation of a wholesale customer or counterparty to the board regulated institution, and they took out the language including a wholesale deposit, and they added that is not a secured lending transaction or a security. Unsecured wholesale lending does not include asset exchanges. Perfect. Sweep deposit means a deposit held at the board regulated institution by a customer or counterparty through a contractual feature that is automatically transfers to the board regulated institution from another regulated financial company at the close of each day, amounts identified under the agreement governing the account from which the amount is being transferred. They've also reinterpreted what a collateralized deposit means by adding some new language, such as required to be, and added receivership, bankruptcy, insolvency, liquidation, resolution, or similar proceedings. And we also have unconditionally cancelable, which means with respect to a credit or liquidity facility that a board regulated institution may at any time with or without cause refuse to extend credit under the facility to the extent permitted by applicable law. So those are all the definitions that fall within this new standard. So now let's look at the new standard itself. It's called the Net Stable Funding Ratio. It's found in subpart K. I will link this down below, and I'll also link the PowerPoint below as well. So it's the Net Stable Funding Ratio. It was first created in February 11th of 2021. It was just effective as of the 1st of July. Now what is it? So you can see by the text here that everything in green is added. So this entire section called the Net Stable Funding Ratio was just added yesterday. Basically, the Net Stable Funding Ratio is a weighted rating that must be achieved at a 1.0 on an ongoing basis in accordance with this subpart. Calculation of the Net Stable Funding Ratio is determined by two things, the ASF amount and the RSF amount. Now the ASF amount, or the ASF factor, is basically a reliability scale for funding. The higher the percentage, the more reliable the funding source is. The lower the percentage, the less reliable the funding source is. You have different tiers that make up the ASF factors, and it takes a different set of criteria to meet each different percentage tier. So in order for a board regulated institution to meet that 100% ASF factor, it has to be an NSFR regulatory capital element or an NSFR liability that has a maturity of 1 year or more from the calculation date, is not described in paragraph D9, and is not a retail deposit or brokered deposit provided by a retail customer. We also have RSF factors. Now this is basically a liquidity scale. 0 equals it is fully liquid, 100% means it is illiquid and needs financing. A RSF factor of 0% is going to be an unencumbered asset. So anything RSF related will be an unencumbered asset, and it does not apply to currency and coin, or 0% will be currency and coin. So 0% will need 100% financing. And now that we know that about the ASF and the RSF, and we know it has to be a 1.0 or higher, and is derived from newly defined factors such as the ASF and RSF, which are as follows, for reiteration: the amount of an ASF is measured based on the board characteristics of the relative stability of an institution's funding sources, including the contractual maturity of its liabilities and the differences in the propensity of different types of funding providers to withdraw their funding. The amount of RSF is measured based on the broad characteristics of the liquidity risk profile of an institution's assets and off-balance sheet exposures. So basically, they're trying to get an idea of who's in trouble and who's not, and they're going to take corrective action as necessary to get this rating at a 1.0 or higher, weighted by those two factors. This is the table right here. So last video we discussed these different categories of institutions. These are the percent thresholds that must be met for the RSF factor. So they're going to need to be financing most of it, because anything less than a 70% is going to be required, or it's going to be more liquid. So it looks like some accountability is actually being created. Now, next, we're going to finally put all this together and look at the disclosure requirements and what happens if the banks fall short of this 1.0 NSFR requirement. Now, they've added a couple new sections here as well. 249.110, NSFR shortfall, supervisory framework, what happens if you don't get to that 1.0. Then you have the timing, method, and retention of disclosures. Availability, disclosures provided under this subpart must remain publicly available for at least 5 years. So that's good to know as well. And this is a little snippet of the form, the new disclosure form that I'm going to show you in the next video, and some of the things that it requires that they report. Again, this is all new. Hopefully this all makes sense so far. I'm trying to slowly tie it all together, and in the last one it should tie it all together fairly well. So to reiterate, we took a look at the NSFR effective July 1st. It's basically a new measurement of reliability of funding and liquidity, determined by two factors, the RSF and the ASF, which each play their own part in determining this new NSFR factor. Anything that's not an NSFR regulatory capital element or falls below that 1.0 mark is considered a liability and must be reported on this form that I just showed you. Hope this helped. Happy 4th. Okay, now that we've broken down the 4 parts that are affected by these Title 12 changes, or the banking sector changes, I'm going to go ahead and break down specifically Part 249. I'm going to take it from the top. And again, this is involving liquidity risk measurement, standards, and monitoring. Now, the monitoring aspect of this is new language. So before yesterday, monitoring was not included in this as well, which is why you're going to see so much new language that's added in. So the purpose of Part 249 altogether is to establish a minimum liquidity standard, and until yesterday, add a minimum stable funding standard. Now this is new. Again, anything in green is new, anything in red is taken out. So now they've added on a minimum stable funding standard, which I will describe in the next video. This one is just going to be going from the top. I'm going to go over the purpose and who this affects as far as banking members and the authoritative action that can be taken if these institutions do not meet the criteria set forth in these changes. So applicability, a board regulated institution is subject to this new standard and other requirements if it is a global systematically important BHC, which you can find a list of these at this link right here. I'm going to link this PowerPoint below. It is a GSIB or global systematically important bank. The most up-to-date list is a 2020 list. This will be updated November of this year. It includes banks such as Citigroup, HSBC, JP Morgan Chase, Bank of America, Bank of China, Deutsche Bank, Mitsubishi, UFJ, FG, Agricultural Bank of China, Bank of New York Mellon, Credit Suisse, Goldman Sachs, you name it, all the big names. A Category 3 is a depository institution holding company that is identified as a Category 3 pursuant to Rule 252.5, which I will link in the next slide, which actually will define all of these categories of banking for this link right here. If you go to this link right here, you'll be able to see what makes up Category 2, 3, 4, etc. But basically, Category 2, based from 252.5, is a banking organization with 700 billion or more in average total consolidated assets, or a foreign banking organization with 700 billion or more in average U.S. assets. Is also a U.S. bank holding company with 100 billion or more in averaged total consolidated assets. And for a foreign bank, 100 billion or more in average combined U.S. assets. And it can also not be a global systematically important BHC. So Category 4, basically a Category 4 cannot be a Category 3 or 2, obviously. It cannot be a or it cannot be a BHC or a GSIB. And it has to have 100 billion or more of average combined U.S. assets if it's a foreign bank. Now, if it's a U.S. bank, it has to have 100 billion in average total consolidated assets. So Section 249.2 continued. This section here, reservation of authority, saw an entirely new paragraph added. And the paragraph reads as follows. The board may require a board-regulated institution to maintain an amount of available stable funding greater than otherwise required under this part, or take any other measure to improve the board-regulated institution's stable funding if the board determines that the board-regulated institution's stable funding requirements as calculated under this part are not commensurate with the board institution's funding risks. So basically, they're creating an entirely new funding risk measurement standard that will apply to the banks that we just went over previously. And in making determinations under the section, the board will apply notice and response procedures as set forth in 12 CFR 263. Now, if we go look at 263.202, it's titled Directives to Take Prompt Regulatory Action. This is what we want to see. Now, paragraph 1 in general. The board shall provide an undercapitalized, significantly undercapitalized, or critically undercapitalized state member bank, or, where appropriate, any company that controls the bank, prior written notice of the board's intention to issue a directive requiring such bank or company to take actions or to follow prescriptions described in Section 38 that are within the board's discretion to require or impose under Section 38 of the FDI Act. That's when we stop and we go take a look at what 38 of the FDI Act is, so we can see what action they're talking about. So if we go and we take a look, why is it going backwards? I hate this PowerPoint sometimes. So if we go and take a look at this Section 38 of the FDI Act, and we break it down, we can see that on the previous slide it said the board's discretion to acquire or impose under Section 38, and then 38E5, F2, F3, or F5. We're going to look at all these. So Section 38, prompt corrective action, tits jacked. Section 38E5 would be provisions applicable to undercapitalized institutions. Discretionary safeguards. The appropriate federal banking agency may, with respect to any undercapitalized insured depository institution, take actions described in any subparagraph of subsection F2, which is provisions applicable to significantly undercapitalized institutions and undercapitalized institutions that fail to submit and implement capital restoration plans. So F2, specific actions authorized. The appropriate federal banking agency shall carry out this section by taking one or more of the following actions. A, requiring recapitalization, doing one or more of the following. Requiring the institution to sell enough shares or obligations of the institution so that the institution will be adequately capitalized after the sale. 2, further requiring that instruments sold under Clause 1, what we just said, be voting shares, not hypothecated or synthetic. They must be voting shares or real shares. So people saying this isn't relevant to a squeeze are insane and have not looked at any of the language here within. So hopefully this all made sense. So to reiterate, Part 249 added monitoring standards and a minimum stable funding standard that we're going to break down in the next video. It affects a plethora of categories of institutions that we went over in this video. And it also created a new paragraph allowing for the board to maintain amount of this new rule that was set forth, and if this is not met, they are directed to take prompt action, including requiring the institution that doesn't meet this new standard to sell enough shares or obligations so that the institution will be adequately capitalized after the sale. So if you're not meeting the new threshold that we're going to go over next time, you're going to get your shares sold by the board. They're obligated to do so. So hope this made sense. I'm going to continue on with this, and next time we're going to take a look at the NSFR standard that they're talking about, the factors that make up this new standard, as well as some new definitions set forth. What's going on, everyone? Charlie here. So as you all know, been vehemently, if that's how you say it, vehemently working on this Title 12 banking sector stuff over the weekend. It's pretty crazy because, number one, we have disclosure requirements for the first time as far as between the banks and the regulators. We also have public disclosure. So this is huge. And now the things they have to disclose is what we're going to be looking at next. And it's all comprised in the ASF and the RSF thresholds. So we're going to look at the ASF in this video and break down what makes an ASF factor 100% versus 95% versus 90%, etc. Now, the higher the percent, the more reliable the funding. The lower the percent, the less reliable the funding. So the key here is to see what category or what asset/liabilities are they going to be able to use to inflate their books, if anything at all. So real quick, 249.131, brand new section in this part of the Federal Code of Regulations. So general, a covered depository institution holding company, U.S. intermediate holding company, or covered non-bank company must publicly disclose the information required by this subpart in the format provided in Table 1 to this paragraph. Now, Table 1 is right here. For the purpose of this video, I only have the ASF items on here. There is a lot more that must be reported, but for this video, we're just going to cover the ASF items and what makes each threshold reliable or not reliable. Now, of course, the ASF and RSF are two important factors, or two important percentages that derive the new net stable funding ratio, which must be at a weighted average of 1.0 for all of these banks. Otherwise, bad things could happen. So let's go ahead and take a look at what makes the ASF reliable or not reliable. So an ASF factor of 100% or reliable funding. Again, new section. NSFR regulatory capital elements and NSFR liabilities assign 100% ASF factor. An NSFR regulatory capital element or NSFR liability of a board regulated institution is assigned a 100% ASF factor if it is one of the following. An NSFR regulatory capital element, which only means it is a capital element included in a covered company's common equity, Tier 1 capital, additional Tier 1 capital, and Tier 2 capital. So I'm assuming it's cash on hand. An NSFR liability that has a maturity of 1 year or more from the calculation date, because ASF is a measurement for 1 year of reliability, and is not described in paragraph D9, which paragraph D9 just says that a ASF factor of 100% cannot be 100% if it's 50%, obviously, and it can also not be 100% if it is a liability owed to retail or a counterparty that is not a deposit and is not a security issued by the board institution. Now, NSFR liability is basically, all that means is it's anything that's not a capital element. So ASF factor of 95%. We have some newly defined terms in here. Basically, the key takeaways from here is for an ASF factor to be a 95%, it has to be a stable retail deposit regardless of maturity or collateralization held at the institution, or a sweep deposit. Now, a sweep deposit is just a deposit held at the FDIC supervised institution by a customer counterparty through a contractual feature. Basically, insured accounts. Now, also, it has to be entirely covered by deposit insurance. So as you can see, to get that factor of 100% or a 95%, you have to have reliable funding. It can't be uninsured, bad assets. It's got to make sure it has value in it. So that is good to see. And then also the board regulated institution demonstrates to the satisfaction of the board that a withdrawal of such deposit is highly unlikely to occur during a liquidity stress event. So in the case that they have an event such like this, they don't want unreliable funding, because if they have to tap into it, you can see how that could get bad. ASF factor of 90% would be a retail deposit regarding a maturity or collateralization, a brokered reciprocal deposit, which actually was just defined. Brokered reciprocal deposit means a broker deposit that an FDIC supervised institution receives through a deposit placement network on a reciprocal basis, such that for any deposit received, this was newly added, the FDIC supervised institution, as agent for the depositors, places the same amount with other depository institutions through the network, and each member of the network sets the interest rate to be paid on the entire amount of funds it places with other network members. So crazy stuff right there. Now before, check this out, broker deposit, the terminology before says from or through the mediation or assistance of a deposit broker, as that term is defined in section 29 of the Federal Deposit Insurance Act. And then they took out this sentence, and includes a reciprocal broker deposit and a brokered sweep deposit. No, it just says and the Federal Deposit Insurance Corporation. So it seems to me like we're skipping the broker dealers and we're going straight to the regulators, and we're taking out the middleman. This could be huge. Yeah, tits already jacked. So ASF of 50%. Now I'll let you pause and read this if you want. The main thing I took away from this is that a 50% factor was going to be a NSFR liability owed to a retail customer or counterparty that is not a deposit and is not a security issued by the board institution. So that sounds like shorts or share lending would fall under the 50% category, or only to be available for about 6 months. Now, a factor of 0%, check out number 1, a trade date payable that results from a purchase by the board regulated institution of a financial instrument, foreign currency, or commodity that is contractually required to settle within the lesser of the market standard settlement period for the particular transaction and 5 business days from the date of sale. So FTDs, tits jacked, don't know. But yeah, you can see everything's highlighted in green because it's all new added language. So this is just 1/3 of it. Okay, so next video I'm going to show you the RSF factors, what makes up those different thresholds. But they're definitely trying to categorize their funding, their collateral, whatever you want to call it, to see the value or the the tier which will fall under. So it's crazy to see all this happening. So hope this helped. I'll go make the RSF next. So to reiterate, if you want reliable funding, you cannot use shorts, FTDs, share lending, rehypothecation, at least based on what this is saying. So the question is, will it be enforced? That is always the question. So hope this helped. I'll bring you the next one here in just a little bit. What's going on, everyone? Charlie here. We're going to talk about the RSF factor threshold. So in the ASF factor, we had language that made them basically include things like fail to deliver and securities lending. And they left out the shorts, so that's where the RSF factor comes in. So we're going to talk about the thresholds and disclosure required around the RSF factor. It's the other part that derives that NSFR, or the net stable funding ratio, that must be a 1.0 or higher, or administrative enforcement could happen. So this is the disclosure form. I'm going to leave this PowerPoint below in the description so you can take a look. I'm not going to read everything verbatim. I'm just going to go over important parts. This is the disclosure template. You can see here there's quite a bit to it. I'll let you read that. But it says right here, a covered depository institution holding company, U.S. intermediate holding company, or covered non-bank company must publicly disclose the information required by this subpart in the format provided in Table 1 to this paragraph. Now, if you look at the previous one, and I apologize, I actually didn't give a side-by-side comparison. You can find it online. It only had average unweighted amount versus average weighted amount. There was no time frame. So the difference here is we have a lot more categories. We have a lot of new defined terms, and we actually have a different selection of categories based on time frame. So RSF factors, again, a factor of 100%, all that means is the asset or exposure needs to be entirely financed by stable funding because it is illiquid. This is, for instance, the case for all loans to financial institutions with a residual maturity of 12 months or more. An RSF factor of 0 applies to fully liquid and unencumbered assets. In Table 1 right here, paragraph B, required stable funding adjustment percentages. You can see this right here. These are different categories of board regulated institutions that you can find in a previous video that I made for this series. And by the way, I always leave the playlists with all of this in it at the end of each video. So if you're unsure about what I'm talking about in some area, I've basically covered all of it. You just go to this playlist and you can find the video that's relevant. So again, before we get into the thresholds, a brokered reciprocal deposit, that's been redefined by switching the words around. It was called a reciprocal broker, or reciprocated broker deposit before, but now it's brokered reciprocal deposit. And basically, they've changed it to where now it's received through a deposit placement network other than a counterparty or a customer. So now instead of going to that, it goes through a deposit placement network on a reciprocal basis, meaning that if someone makes a big deposit, on the other end, they've got to make the same deposit to make a net zero. Basically right here, deposit placement network means a network in which an insured depository institution participates together with other insured depository institutions for the processing and receipt of reciprocal deposits. Now, basically, it requires that a bank collateralize or otherwise secure the deposit with treasuries or ultra-safe, highly liquid government securities, which is an added cost to the banks for them to do this. So the different thresholds. What makes up a 0% RSF factor? Well, basically because it's fully liquid, anything currency and coin related, anything a cash item in the process of collection, reserve bank balance, or other claim on a reserve bank that matures less than 6 months. And it's common language that anything maturing less than 6 months will fall underneath the 50% RSF factor. It can also be a level 1 liquid asset that's not described in these first few paragraphs here, which is cash, central bank reserves, and certain marketable securities backed by sovereigns and central banks, among others. So 5 and 15%. For the 5%, it just has to be the undrawn amount of a committed credit facility or committed liquidity facility, is the entire unused amount of the facility that could be drawn upon within 1 year of the calculation date under the governing agreement. For the 15% RSF factor, it basically is level 2A liquid assets or certain government securities, covered bonds, and corporate debt securities. 50% level 2B assets, basically corporate bonds, residential mortgage-backed securities, and equities that meet certain conditions, and the conditions are all going to be based around time frame, such as 6 months or more, but less than 1 year. Now, a secured lending transaction basically is a transaction that's subject to legally binding agreement of the calculation date and gives a cash obligation of a counterparty to the national bank or savings association that is secured under law by a lien on assets owned by that counterparty. And this, of course, gives priority over the assets in the event that the counterparty enters into receivership, bankruptcy, insolvency, liquidation, resolution, or similar proceedings, including reverse repo and securities borrowing transactions. Unsecured wholesale lending means a liability or general obligation of a wholesale customer or counterparty to the institution that is not a secured lending transaction or a security. It says that unsecured wholesale lending does not include asset exchanges. Now here is the 85%. Basically, it's assigned to a retail mortgage that matures 1 year or more, secured lending transaction that matures 1 year or more from the calculation date, and a publicly traded common equity share that is not HQLA, a security other than a publicly traded common equity share that matures 1 year or more after calculation date and is not HQLA. So 100%, this is where it gets cool, because 100% are unencumbered assets, of course, and basically they're non-performing assets. Any non-performing asset that is past due by more than 90 days or non-accrual will be assigned this 100% RSF factor, meaning it is illiquid. Now, if you read this right here, 100% also falls on off-balance sheet rehypothecated assets. When an NSFR liability of a board-regulated institution is secured by an off-balance sheet asset or results from the board-regulated institution selling an off-balance sheet asset, for instance, in the case of a short sale, other than off-balance sheet asset received by the board institution as variation margin under a derivative transaction. If the board-regulated institution received the off-balance sheet asset under a lending transaction, an RSF factor is assigned to the lending transaction as if it were encumbered for the longer of the remaining maturity of the NSFR liability, and 2, any other encumbrance period applicable to the lending transaction. So I like how they put specifically, for instance, in the case of a short sale. So you have it. That's basically it. I'll leave this PowerPoint below. It says right here, if the board regulated institution did not receive the off-balance sheet asset under a lending transaction or asset exchange, an RSF factor is assigned to the on-balance sheet asset resulting from the rehypothecation of the off-balance sheet asset, as if the on-balance sheet asset were encumbered for the longer of the remaining maturity or any other encumbrance period applicable. So take that for what it's worth. I'm very, very excited for tomorrow. See what happens.